And the last method, which can be used in order for a company to determine whether they should invest in a long-term asset or not, is the internal rate of return. And please note, guys, the internal rate of return is just the cost of capital that discounts your investment cash flows to a net present value of 0. So let's look at the example below. Sierra Limited sells appliances and they are considering a 100,000 Rand investment with the following cash flows, and you can assume a weighted average cost of capital of 8%. So you guys can see initially at the beginning of year 1, we have a cash outflow of 100,000 Rand. That's the cost of the investment. And then we have cash inflows for a 4-year period. So this is exactly the same example that we've been looking at with all of our previous methods. So using the cash flow function on your calculator, you are going to input all of these cash flows. So remember to show your calculator steps. And then guys, you are just going to solve for the internal rate of return. Now please remember I said to you above, the internal rate of return is just the point where my net present value is 0. So if you had to input all of these cash flows into your calculator and you used a rate of 20.1%, you put that in as I, and you solve for your net present value, you are going to get an answer of 0. So that's very important to note. The internal rate of return is just the point where your net present value is 0. We then need to conclude whether the company should accept this investment or not. So what you need to do is you compare your internal rate of return to the weighted average cost of capital. And if the internal rate of return is greater than the weighted average cost of capital, that means that the investment has a positive net present value and it should be accepted. So you can see that just below, because the internal rate of return is greater than the weighted average cost of capital, the investment has a positive net present value and it should therefore be accepted. So we've got our decision criteria just below. If our investments are independent, meaning you can accept all of the investments if you want to, you can reject all of them if you want to, all investments where the internal rate of return exceeds the cost of capital should be accepted. So we saw that above. If the IRR is greater than the WACC, we accept because it means the project has a positive NPV. If the IRR is less than the WACC, reject because it means that the investment has a negative NPV. If we are dealing with mutually exclusive investments, meaning we are comparing many different investments, but the company doesn't have enough money available to select all of the investments, they can only select one of the investments, then we select the alternative with the higher internal rate of return. We then need to look at 2 disadvantages of the internal rate of return method. The first disadvantage is the rankings may differ from the NPV decision. Let me give you an example over here. Let's say the company is considering 2 different investments. We have investment A and we also have investment B. When I perform the calculation using the NPV method, I find that investment A has a higher net present value. So if A has a higher net present value, we would invest in A. On the other hand, I perform the same calculation but using the internal rate of return method, and I find that investment B has a higher internal rate of return. And we saw just above, if the projects are mutually exclusive, we should select the alternative with the higher internal rate of return. So I am then going to invest in B. So this is what I mean. Your rankings may differ from the NPV decision. If we perform the calculation using the NPV method, we conclude that we should invest in A. However, if we perform the calculation using the internal rate of return method, we then conclude that we should invest in B. So we have conflicting rankings. And the reason for this is because the incorrect reinvestment assumption is made when we calculate the internal rate of return. So this is actually the incorrect answer. The correct answer is we should invest in A. We should not invest in B. And the reason why the internal rate of return method gives me the wrong answer is because they make the incorrect reinvestment assumption. So what am I talking about over here? With the internal rate of return method, we assume that all cash that is received as a result of the investment is reinvested at a return equal to the internal rate of return. So let me explain that in more detail. If we go above, what the internal rate of return method assumes is these cash flows that we receive over here in year 1, 2, 3, and 4, all of these cash inflows that we receive as a result of this investment, this method assumes that we can reinvest those cash flows at a return equal to the internal rate of return. Meaning, when I receive these cash flows, it assumes that I can reinvest those cash flows at a return of 20.1%. That is what the internal rate of return method assumes. On the other hand, the net present value method assumes that all cash that is received as a result of the investment will be reinvested at a return equal to the weighted average cost of capital. So how is this different? With the NPV method, we assume that all of these cash flows that we receive as a result of the investment will be reinvested at the WACC of 8% and not the internal rate of return of 20.1%. And just below, I said to you that the NPV calculation is correct. The NPV calculation makes the correct reinvestment assumption, so your answer is correct. The internal rate of return method makes the incorrect reinvestment assumption, so the answer that we get with that calculation can be incorrect. Why is this reinvestment assumption incorrect? Just below, let's read through this paragraph. Since the reinvestment rate is normally lower than the internal rate of return, the net present value method is superior to the internal rate of return method. So all I'm saying in that sentence is, with the internal rate of return method, we assume that these cash flows that we receive can be reinvested at the internal rate of return. However, that is not realistic. Chances are we will not be able to reinvest those cash flows at a rate of 20.1%. That is actually too high. So the internal rate of return method is making the incorrect reinvestment assumption because the return that we can normally get on these cash flows is going to be lower than the internal rate of return. So that is why the net present value method is superior, because the net present value method assumes that we invest these cash flows at a lower rate, not the internal rate of return, but the weighted average cost of capital. And it is a lot more realistic to assume that we will be able to invest these cash flows at a return of 8% instead of 20.1%. Now, guys, I want you to go back. When we discussed the net present value method, I said to you that the NPV method is superior to all other methods. I said to you we're going to come back to this a bit later. You can now see the net present value method assumes that all cash flows that are received from the investment will be reinvested at the weighted average cost of capital. And this is the correct reinvestment assumption. So that's why it's superior to the internal rate of return method. With the internal rate of return method, we make the incorrect reinvestment assumption. We assume that funds will be reinvested at the internal rate of return instead of the weighted average cost of capital. then please note it is possible to correct this problem by calculating the modified internal rate of return. So instead of calculating the internal rate of return, we calculate a modified internal rate of return. And if you perform that calculation, your answer will then be consistent with the NPV method. So the NPV method told us to rather invest in A. The internal rate of return method said B. But if I had calculated the modified internal rate of return, it would be consistent with the NPV method. In other words, I should invest in A. But please note, guys, this is a level 1 for psycho purposes. So you do not need to be able to perform the calculation of the modified internal rate of return. You just need to be aware of it. And then another disadvantage of the internal rate of return method is if my cash flows change direction more than once, the investments will have more than one internal rate of return. So I want to look at an example just to explain this in a bit more detail. On the next page, you can see we have Baxter Limited is considering an investment with the following cash flows. So first, we have an outflow of 50,000 Rand. We then have a cash inflow, and then we have an outflow again. So guys, you can see the direction of my cash flows is changing more than once. It goes from negative to positive to negative. And if you input these cash flows into your financial calculator, if you use a discount rate of 5%, so input these cash flows, make I 5%, you will get an NPV of 0. Similarly, if you input those same cash flows, but you make I 50% instead of 5%, you are also still going to get a net present value of 0. Now, please remember, the internal rate of return is just the point where your NPV is 0. So if both of these calculations are giving me an NPV of 0, that means that this investment has got two internal rates of returns. It has an internal rate of return of 5% and an internal rate of return of 50%. Now, the problem with this is if we have a weighted average cost of capital of 8%, if this investment has an internal rate of return of 5%, the IRR is less than the WACC, so we would reject the project. However, if the IRR is 50%, it's then more than the weighted average cost of capital, and we would then accept the investment. So you can see this is a disadvantage of the internal rate of return method, because where we have multiple internal rates of return, we don't know whether the project should be accepted or not. Now, please just note further, guys, it's not possible to input these cash flows into your calculator and actually solve for the internal rate of return. Depending on what financial calculator you have, either your calculator will not perform the calculation, it will just give you an error message, and then you know there's more than one internal rate of return, so it's not giving me an answer. Or if you have a different financial calculator, what it might also do is it only gives you one of the answers. It either gives you the 5% or the 50%, because it's obviously not possible for your financial calculator to give you two different internal rates of return. So please don't try and input these cash flows and solve for the internal rate of return. It won't work. The only reason why I know that this investment has two internal rates of return is when I discount those cash flows at 5%, or when I discount them at 50%, I get an NPV of 0. And I know that my internal rate of return is the point where my NPV is 0. So guys, we have now looked at the three different methods that can be used by companies in order to determine whether they should invest in a long-term asset or not. They can calculate the payback period or the discounted payback period that takes time value of money into account, or they can use the net present value method or the internal rate of return method. Now, please note, we did already cover this. The net present value method is the most superior method. It is better than all other methods. So if the question is silent, they don't tell you which method to use, please use the NPV method. And now that we have covered all of the different methods, we just need to look at a few other important concepts which you need to be aware of before you can actually start answering questions. So the first thing that we need to discuss in a little bit more detail is the discount rate. So in other words, guys, when you calculate your net present value, what do we use as the discount rate in order to get that NPV? And you've already seen, when we covered the net present value method, I gave you the weighted average cost of capital of the company, and we used that weighted average cost of capital as the discount rate to calculate our NPV. So we already know that the correct discount rate to use is the target weighted average cost of capital of the company. Now I just want to discuss in a little bit more detail why we use the target WACC as our discount rate. Let's look at the example below. You've been given the capital structure of Daisy Limited. First, we have their target capital structure. So remember, guys, the target capital structure is just their optimal capital structure. And just as a bit of revision from our lecture on weighted average cost of capital, my optimal or my target capital structure is where my weighted average cost of capital is minimized, and that is where my company value is maximized. So this is the ideal capital structure for this company. They would like to have 50% debt and 50% equity in their capital structure. What do they currently have? Currently, they've got 40% debt and 60% equity. So currently, they've got too much equity in their capital structure. We are then told that they have a cost of debt of 14% and their cost of equity is 24%. Now, I want you to assume that this company is considering whether or not they should invest in investment A. And they have calculated that investment A has an expected return of 18%. So like I already said, currently Daisy Limited has too much equity in their capital structure. So they are going to therefore finance investment A using debt, so that they can try and move closer to their target or their optimal capital structure. So look at what happens if we match this investment to the particular source of funds. In other words, if we match the investment to debt financing. We know that the investment has an expected return of 18% and the cost of debt is 14%. So the investment return is higher than the cost of debt, and because of this, we would accept investment A because it will yield a return higher than the cost of debt. Now I want you to assume that later in the same year, Daisy Limited wants to invest in investment B, and investment B has an expected return of 20%. However, since investment A was financed using debt finance, I want you to now assume that the company has too much debt in their capital structure. So investment B is going to be financed using equity finance. So once again, if we match the investment to the particular source of funds, in other words, if we assume that investment B is going to be financed through equity, we know that the investment has a return of 20%. What is my cost of equity? The cost of equity is 24%. Now what am I going to do? The investment return is lower than the cost of equity, so I'm going to reject this investment. So investment B would be rejected because its expected return is less than the cost of equity. Now I want you to ask yourself whether this makes sense. We accepted investment A, and investment A had an expected return of 18%. We accepted that. However, investment B has an expected return of 20%, and we are rejecting investment B. That does not make any sense. Why would you reject an investment that has a higher return than a previous investment that you have already accepted? So please refer to the discussion just below. This does not make any sense. Investment A had a return of only 18% and will be accepted. However, investment B with a higher return of 20% is going to be rejected. And what is the reason for this? This is because the investment is being incorrectly matched to the source of funds. When we were deciding whether or not to accept investment A, we compared our expected return to the cost of debt. And when we were deciding whether or not to accept investment B, we compared our expected return to the cost of equity. We matched the investment to the particular source of funds, and that is not correct. When we are deciding whether or not to invest in a project or not, what do we compare the return to? The target weighted average cost of capital. We never use the cost of debt or the cost of equity as our discount rate. We use the target WACC as our discount rate when we calculate our NPV. Or if we are calculating the internal rate of return, we compare the internal rate of return to the target WACC. We don't compare the internal rate of return to the cost of debt or the cost of equity. We always use the target WACC as our discount rate. So let's look at the logic behind why we do that. And this is referred to as the pooling concept. Now, according to the pooling concept, we use the target WACC in order to evaluate new investments. So let's calculate the target weighted average cost of capital for this company. Remember, in order to calculate the target weighted average cost of capital, we use their target capital structure. So we're going to take the cost of debt multiplied by 50% and the cost of equity multiplied by 50%. And that will give me the target weighted average cost of capital. Now, if we are trying to decide whether we should accept the investments or not, we compare the expected return to this target weighted average cost of capital. So investment A has an expected return of 18%. It's now going to be rejected because the return is less than the target WACC. And on the other hand, investment B, which has an expected return of 20%, is going to be accepted because the return is greater than the target weighted average cost of capital. And that makes logical sense. We are accepting the investment with a higher return and rejecting the investment with a lower return. So please note, the manner in which an investment is financed does not impact on the performance of the asset. So the method of financing is ignored when we make the investment decision, and we use the target weighted average cost of capital as our discount rate. So guys, to give you an example over here, I want you to assume that both you and your friend decide you're going to buy Ferraris. You decide you're going to pay cash for your Ferrari, and your friend finances his Ferrari through the bank. You then both decide you're going to race. Please note, it's exactly the same Ferrari, same engine size, same everything. The only difference is the manner of finance. You purchased the Ferrari for cash, your friend financed it through the bank. If you guys race, who's going to win the race? Does the method of financing impact on the performance of the asset? Not at all. So please note, when we are making the investment decision, we do not care how the asset is going to be financed. You ignore the financing. We don't care if it's going to be financed through debt or equity. We ignore that. When we are making the investment decision, we use the target WACC as our discount rate. If it has a positive NPV, we know that it's a good asset, so we should invest. If it has a negative NPV, we know that it's not a good asset, so we don't invest. After we've made the investment decision, so let's say we've now decided our asset has a positive NPV, so we are going to invest. After you have made the investment decision, You then decide how you are going to finance the asset. But the financing does not impact on your investment decision. The financing decision is a completely separate decision, and we deal with the financing decision in a completely separate lecture. So if our investment yields a positive net present value, then after we've performed the investment decision, the company will then decide how they are going to finance the investment so that they can move towards their target capital structure in the long term. So please note, companies are never at their target capital structure. So this company's target was 50% debt, 50% equity. They're not currently at their target. However, whenever they raise new finance, they will try and move closer towards their target capital structure. So when we perform the investment decision, we do not take the method of financing into account. Instead, we use the target WACC as our discount rate. If the investment has a positive NPV, we then decide how we are going to finance the investment, and we try and move closer towards our target capital structure.